Hello everyone. Today I am going to take you through the energy and power sectors. I will start by giving you an overview of the first type of energy, the oil and gas industry. Crude oil is the most important commodity in the world and is among the key components for energy and manufacturing purposes. It is refined to produce petrol, diesel, and other such fuels, along with being a key component for making plastics and paints. India is the third largest consumer of oil in the world, while being the second largest refiner in Asia. India is also the fourth largest LNG importer in the world. The oil industry is primarily divided into three segments: the upstream segment, which is engaged in the business of exploration and production of oil; midstream segment, which is primarily engaged in the logistics aspect of the business; and the final segment is the downstream segment, which is involved in the conversion of crude oil into more refined products such as diesel, petrol, ATF, and kerosene, among others. We now look at some important aspects of these oil companies, starting with the most important factor, gross refining margins. This basically tells us the difference between the price at which oil was purchased and the realized value of sale from refined products. As you can see, Reliance Industries produces the highest GMR among peers at USD 8.9 BBL, where others barely manage to even remain positive, indicating the efficiency and profitability Reliance generates and its superiority in the refining industry. Moving on, we now look at the production scale of companies. As you can see, ONGC is the largest producer of both crude oil and natural gas. ONGC produced over 20 million tons of oil in both 2018 and 2019, which is larger than others combined. This indicates the market share ONGC commands over peers in the Indian oil industry. With oil being key for energy, ONGC stands to benefit from the sheer scale of its operations. Moving on, we now look at the second type of energy, power sector. India is currently the third largest producer and consumer of power in the world. Power in India is generated by four means. These are thermal, which contributes to 62.4% of power; renewables such as wind and solar are the second largest, third being hydro, and the smallest segment is nuclear. When looking at the power industry, it is critical to understand the differences between GenCos, Transcos, and Discoms. GenCos are power generating companies which install facilities to create electricity. These companies usually incur high capex to set up facilities to do this and are highly capital intensive. Following this, we have Transcos, which are transmission companies, which basically transfer electricity from GenCos over to Discoms. These companies usually transfer energy over long distances to areas with insufficient generating capacities. The final segment is the distribution companies or Discoms. These companies buy power from GenCos or Transcos and distribute it to the final consumers, which are industries, households, commercial spaces, etc. Here, we look at the capacity and utilization levels of power companies. As can be seen, NTPC is the elephant among peers, with conventional capacity of over 54,000 megawatts and a capacity utilization of 70%, which is among the highest in the industry. This indicates the scale, efficiency, and reach the company has in the power industry and its capacity to realize gains as the country's power infrastructure develops over the longer term. Another factor to look at is the realizations per unit, which is an important metric to assess the amount of revenue a power company makes towards producing and selling a single unit of electricity. Higher the realization, higher the amount of revenue the company makes. Adani Power makes the highest amount of realization at Rs 4.05 per unit, while NTPC has the second highest realizations at 3.73 per unit. Therefore, while NTPC operates at such high scale, it generates revenue per unit which is in the upper band of the industry, indicating its capability towards realizing revenues and leveraging its scale properly. Moving on to the return ratios, we can see that all the companies have generated over 10% in ROEs in an industry which is characterized by low levels of ROEs generally. These companies have also delivered consistent cash flows. As the industry is very mature, the companies in this sector are not known to give higher than GDP growth rates, but are known to be very stable cash cows. On the valuations, as you can see, these companies trade at PE ratios below the broad market, with PE ratios ranging between 10 to 15x in the energy sector. Another factor to look at is the EV/EBITDA, since a lot of these companies carry large debt. An ideal ratio ranges between 7 to 10x, and most of the portfolio companies trade either within or under this band, indicating attractive valuations. We now move on towards the risk factors that can affect the industry. A key risk is the volatility of crude oil prices, which can significantly affect profitability of companies irrespective of the segment they serve. Volatility, such as the one witnessed in May where oil turned negative, has caused severe impact on profits and can have similar impact going forward. Hence, investors should be cautious about volatility. With the environment concerns and global warming awareness rising, a lot of governments and companies are looking at alternative sources of energy. While these companies are dependent on the traditional sources of energy, they will have to be proactive towards adopting new energy sources so as to remain profitable and relevant over the long term to ensure their survival. With the rise in environmental impact, a lot of governments have been proactive to promote clean energy initiatives while taxing traditional energy producers for their impact on the environment. And investors should be on the lookout to assess any such changes in laws and regulations which can impact companies negatively. The energy sector is highly capital intensive and therefore needs constant capital infusion, which is funded through debt. But sometimes, due to capital misallocation or bad decisions, the company may not be able to generate enough cash flows to pay off debt and maintain profits. This is especially seen with state-owned discoms, which are highly debt-laden and face issues with debt servicing during economic crisis. This was one of the primary reasons to not include any state-owned discoms in the recommended portfolio. With the rising environmental awareness, a lot of auto manufacturers are also moving towards manufacturing electric cars, which have been touted to be the future of automotive industry. Since transportation is one of the key consumers of oil, a shift in the auto industry towards electricity can severely affect the revenues of companies in the future. Therefore, investors should be on the lookout for companies which can accordingly modify their strategy to continue being profitable. We thank you for watching this video and hope you have learned about the energy sector.